All right, the Atlanta Fed out today with their GDP Nowcast. Quite the shocker. Last week, the GDP Nowcast was at 2.3% growth for Q1. Today, look at it. Negative 1.5%. Shocking the financial world. But the question is, of course, is it that bad? Why is this the case? Well, they quickly tweeted out right afterwards explaining the math behind this move, net exports collapsing. Of course, if you dig just a little bit deeper, what you end up finding out is that it's the imports that soared. This makes a ton of sense. Front running those tariffs, building inventories today before the tariffs end up increasing the price of those imports. The question, though, is what is the impact of this potential collapse in GDP on markets, on stocks? And the answer is really not going to end up being an impact. Here's why. When you import something into the United States, that means you're exporting dollars. That is the trade. The exporter to the U.S. gets dollars, the importer gets the good, and that is the transaction. So what does that mean? That means those dollars that got exported, they got to find their way back into the U.S. And more often than not, they find their way back in the U.S. by buying U.S. financial assets. That includes bonds, stocks, that sort of thing. So look, in the end, yes, today's print for the GDP Nowcast was quite shocking, but this will level out as those inventories get used up. We'll see imports slow down now as tariffs turn on, and this will turn out to be nothing more than an amazing artifact of some wild times and trade wars going on.